Did you know that a sneaky number could be quietly dragging your credit score down by up to 30%? We're talking about credit utilization, the ratio of how much you owe compared to your total available credit. It might sound harmless, but this number can make or break your financial reputation. Here's a simple analogy. Think of it like filling up water bottles. If you only have one bottle and fill it to the brim, it's at 100% utilization. In credit terms, this means using all of your available credit limit is risky and can lower your score dramatically. Ideally, you should aim for under 30%. Now, let's debunk a common misconception. Closing old credit cards can actually hurt your score by raising this utilization rate. Why does this matter? A lower credit score means you pay more for loans, credit cards, and even insurance. For example, if your mortgage interest is just 1% higher due to a bad score over 30 years, that's tens of thousands extra. So, the next time you're tempted to max out your card, remember, keeping balances low could save you big money in the long run. Subscribe and uncover more hidden factors that impact your finances. Money Mechanics decodes how money really works, one mechanism at a time.